Overview of foreign currency translation methods. Multinational corporations must convert foreign subsidiary financial statements into the parent company's presentation currency for consolidation purposes. The choice between the temporal method and the current rate method depends on the relationship between the subsidiary's functional currency and the parent's reporting currency. If the subsidiary's functional currency is the same as the parent's reporting currency, the temporal method is used. If the functional currency differs from the parent's reporting currency, the current rate method applies. The functional currency reflects the primary economic environment in which the subsidiary operates and is therefore the key determinant of translation methodology. Understanding these methods is essential because they can significantly affect reported earnings, assets, liabilities, and financial ratios. Application of the temporal method. The temporal method is used when the subsidiary is highly integrated with the parent and shares the parent's functional currency. Under this approach, monetary assets and liabilities such as cash, receivables, payables, and debt are remeasured using the current exchange rate. Non-monetary assets and liabilities, including inventory, fixed assets, intangible assets, and deferred revenue, are generally remeasured using historical exchange rates. Common stock and dividends are also translated using historical rates. Revenues and most operating expenses are translated at average rates, while expenses related to non-monetary assets, such as depreciation, amortization, and cost of goods sold, are translated using historical rates associated with the underlying assets. Effects and exposure under the temporal method. A major feature of the temporal method is that remeasurement gains and losses resulting from exchange rate changes are recognized directly in the income statement. Consequently, reported earnings become more volatile than under the current rate method. Exposure under the temporal method is based on the net monetary position, calculated as monetary assets minus monetary liabilities. A company with net monetary assets benefits when the foreign currency appreciates and suffers when it depreciates. Conversely, a company with net monetary liabilities experiences gains when the foreign currency depreciates. Because most firms have more monetary liabilities than monetary assets, understanding net monetary exposure is important when evaluating the impact of currency fluctuations on profitability. Inventory considerations under the temporal method. Inventory accounting adds complexity to the temporal method because inventory is a non-monetary asset translated using historical exchange rates. The specific rates applied depend on the inventory cost flow assumption. Under FIFO, ending inventory consists of more recent purchases and is translated using relatively recent historical rates, while cost of goods sold reflects older rates. Under LIFO, ending inventory is translated using older historical rates, while cost of goods sold reflects more recent rates. Under the weighted average method, both inventory and cost of goods sold are translated using weighted average exchange rates. These differences can materially affect reported gross profit margins and asset values following currency movements. Application of the current rate method. The current rate method is generally used when a foreign subsidiary operates independently and its functional currency differs from the parent's reporting currency. Under this approach, all balance sheet accounts are translated using the current exchange rate at the balance sheet date, except common stock, which is translated using historical rates. Income statement accounts are typically translated using the average exchange rate during the reporting period. Because both revenues and most expenses use the same average exchange rate, many operating performance ratios remain relatively consistent after translation. The method is designed to preserve the subsidiary's financial relationships while expressing them in the parent's reporting currency. Translation adjustments and analytical implications. Unlike the temporal method, the current rate method records translation gains and losses in cumulative translation adjustment, CTA, a component of other comprehensive income within shareholders' equity. These gains and losses bypass the income statement and therefore do not directly affect net income. Exposure under the current rate method is based on the subsidiary's net asset position, defined as total assets minus total liabilities. If the foreign currency depreciates, a translation loss occurs. If it appreciates, a translation gain results. Analysts must understand the different treatments of exchange rate effects because firms using the temporal method often report more volatile earnings, while firms using the current rate method accumulate currency effects in equity through OCI.